Welcome to the world of managerial accounting. Today, we're diving into job order costing, a critical concept for businesses. Imagine companies unable to track expenses for their unique goods or services. Chaos would ensue. Pricing would be a shot in the dark, and profitability a mystery. Job order costing is the backbone for industries thriving on customization. It tracks costs for each distinct job or order, from idea to final product. This method helps businesses set prices confidently, ensuring profitability while remaining competitive. By the end of this journey, you'll be equipped to apply job order costing principles to real-world scenarios. Job order costing is a dynamic tool used across various industries. From custom furniture makers to film production, it provides financial clarity. Imagine a craftsperson tracking the cost of materials and labor for each unique piece. This helps in pricing custom creations confidently. On a film set, job order costing tracks expenses from script writing to final edit. In professional services, it tracks billable hours and project expenses. Job order costing bridges creativity, craftsmanship, and financial success. It empowers businesses to make informed, data-driven decisions. The business world is dynamic, shaped by global events and economic trends. Supply chain disruptions highlight the importance of job order costing. Imagine a high-end bicycle manufacturer facing increased material costs and production delays. Outdated cost data can erode profit margins. Job order costing tracks actual costs, helping businesses adapt to challenges. It provides real-time insights into financial health. Businesses can make informed decisions about pricing, production schedule, and supplier alternatives. Job order costing helps identify supply chain vulnerabilities and explore diversification strategies. Businesses adopt different approaches to meet customer needs. Some thrive on standardization, like fast food chains. Others embrace customization, like tailors and software developers. Job order costing tracks costs for unique jobs or orders. It ensures accurate determination of profitability and informed resource allocation. This method captures the true cost of fulfilling unique customer demands. It's essential for businesses where customization is paramount. Job order costing guides businesses toward success in bespoke creations. Job order costing is a powerful tool for businesses engaged in customization. It tracks costs for unique jobs or orders. This method provides precise cost information for each job. It captures direct materials, labor, and overhead costs. Job order costing helps businesses measure, manage, and master costs. It provides financial clarity for pricing, resource allocation, and profitability. Businesses can confidently navigate the complexities of a customized marketplace. Let's familiarize ourselves with key terms in job order costing. Job costs include direct materials, direct labor, and manufacturing overhead. Direct materials are raw materials traceable to a specific job. Direct labor encompasses wages for employees working on the job. Manufacturing overhead includes indirect costs essential for production. The job cost sheet records all cost information for a specific job. Understanding these terms is crucial for decoding job order costing. This knowledge provides accurate cost information for customized production. Let's compare process costing and job order costing. Process costing averages costs over a large number of identical products. It's like a fast food chain producing standardized burgers. Job order costing tracks costs for unique jobs or orders. It's like a fine dining restaurant crafting bespoke dishes. Process costing thrives on standardization and high volume production. Job order costing captures the unique cost nuances of each order. Understanding these methods helps businesses choose the right accounting approach. Section 4, Job Order Costing in Entrepreneurship, a tool for success. Job order costing is essential for entrepreneurs to understand costs, set competitive prices, and ensure profitability. It helps optimize workflows, manage resources, and make data-driven decisions. From freelancers to custom furniture makers, job order costing turns creative visions into thriving businesses. Let's step out of the theoretical realm and into the real world, where job order costing plays a pivotal role in the success of countless businesses across a diverse range of industries. From construction to custom jewelry, job order costing provides the financial clarity and control needed to thrive. Imagine a construction company building a state-of-the-art office complex. Job order costing orchestrates the flow of costs, ensuring the project stays on track and within budget. Every expense is meticulously recorded on the project's job cost sheet. This granular approach allows real-time monitoring of the project's financial health. Now, let's shift gears to custom jewelry making. Job order costing ensures fair compensation for the artisan's time, skill, and materials. These examples highlight the importance of job order costing in today's business landscape. Whether it's construction or handcrafted jewelry, job order costing provides the financial framework for success. In the intricate world of job order costing, understanding the flow of costs is akin to following a product's journey from its humble beginnings as raw materials to its transformation into a finished good, ready to meet the demands of the market. This journey, much like a river winding its way towards the ocean, involves distinct stages, each contributing to the ultimate value of the product. Our journey commences in the realm of raw materials, the building blocks of production. Imagine a lumber yard stacked high with planks of wood, a textile mill buzzing with the creation of vibrant fabrics, or a metal fabrication shop echoing with the clang of machinery shaping steel. These raw materials in their unprocessed state represent the initial investment a company makes in its quest to create something valuable. As these raw materials enter the production process, they embark on a transformative journey, much like a caterpillar metamorphosing into a butterfly. This transformation, however, isn't driven by nature's magic, but by the skilled hands of labor and the hum of machinery. This is where direct materials, those readily identifiable with a specific job, and direct labor, the wages paid to those directly involved in the transformation process, come into play. Imagine a carpenter carefully selecting the finest cuts of wood for a custom-built bookcase, a seamstress meticulously stitching together pieces of fabric to create a designer dress, or a welder fusing metal components to construct a sturdy piece of industrial equipment. Each action, each hour of skilled labor adds value to the raw materials, inching them closer to their final form. This intricate dance between raw materials, labor, and the overhead costs associated with production, the rent for the workshop, the electricity powering the machinery, the supervisor overseeing the process, forms the heart of the cost flow in job order costing. By meticulously tracking these costs at each stage, businesses gain a crystal clear understanding of how value is added, enabling them to make informed decisions about pricing, resource allocation, and ultimately profitability. Section 2, the Work in Process Hub, where transformation happens. Raw materials pass through the bustling Work in Process Hub, transforming into finished goods. This stage adds value through labor, machinery, and overhead. Picture a furniture workshop with skilled artisans. A half-built dining table awaits finishing. Nearby, a partially upholstered armchair awaits its next stage. These items are the work in process inventory. They represent significant investment and added value. Imagine a clock ticking as a woodworker carves details. Each tick represents overhead costs added to WIP. Accurate cost tracking in WIP is crucial. It provides a snapshot of value added. This helps in production scheduling and resource allocation. Monitoring WIP costs identifies inefficiencies. High WWIP costs may indicate inefficiencies. WIP inventory is a significant investment. Accurate tracking ensures efficient inventory management. Section 3, the cost of goods sold, reflecting completed value. Finished goods transition from production to sales, reflecting in the cost of goods sold. COGS. COGS includes direct materials, labor, and overhead costs. Accurate COGS calculation is crucial for determining gross profit. Gross profit is revenue minus COGS. Monitoring COGS helps businesses understand profitability and financial health. Section 4, Real-World Snapshot, the Hollywood Strikes and Cost Flows. The 2023 Hollywood strikes halted productions, disrupting cost flows in job order costing. Sets fell silent, and work in process inventory became a financial burden. Studios faced mounting pressure, assessing the viability of resuming projects. This highlights the importance of adaptability and financial agility in managing unforeseen disruptions. In the dynamic world of business, informed decisions are crucial. Job order costing illuminates the path to profitability and efficiency. It provides a clear picture of costs, empowering data-driven decisions for resource allocation and pricing strategies. Imagine a custom furniture maker tracking costs of materials and labor. This insight ensures profitability and competitive pricing. Job order costing transforms data into actionable insights for strategic decisions. In job order costing, precise recording of costs is crucial. It informs financial decisions and ensures profitability. Accurate records help set prices, evaluate job profitability, and improve operational efficiency. Recording costs is the foundation of financial clarity. The lifeblood of any accounting system, journal entries, take center stage in the world of job order costing, meticulously tracking the flow of costs as raw materials transform into finished goods. Like a choreographer documenting the intricate steps of a dance, journal entries capture the movement of financial resources, providing a chronological record of every cost incurred in the production process. Let's imagine a custom bicycle manufacturer, their workshop a haven for cycling enthusiasts seeking unique handcrafted bikes tailored to their exact specifications. The process begins with the purchase of raw materials, such as lightweight aluminum tubing, high-performance components, and vibrant paint finishes. This initial influx of materials triggers the first set of journal entries, recording the increase in raw materials inventory and the corresponding decrease in cash or increase in accounts payable. As these raw materials make their way onto the workshop floor, where skilled artisans transform them into cycling masterpieces, additional journal entries come into play. The cost of direct labor, meticulously tracked through time cards or digital systems, is debited to the work in process inventory, representing the value added by the skilled hands shaping metal, assembling components, and applying paint with meticulous care. Simultaneously, manufacturing overhead costs, those indirect but essential expenses that keep the workshop humming, are allocated to the work in process inventory. This allocation, often based on predetermined overhead rates, ensures that each custom bike reflects not just the cost of materials and labor, but also its fair share of rent, utilities, and supervisory salaries. Finally, as each custom bike rolls off the assembly line, complete with gleaming chrome, a symphony of gears, and the proud artisan's signature, a final set of journal entries marks its transition from work in process to finished goods inventory. This shift reflects the completion of the production process, capturing the full cost of the bike, ready to be paired with its eager owner. Section 3. Navigating inflation. Adjusting for rising costs. In an ideal world, prices would remain stable, materials would be readily available, and businesses could forecast costs with unwavering accuracy. However, the real world often presents unforeseen challenges, and inflation, that persistent upward creep in prices, can disrupt even the most carefully crafted job order costing systems. Imagine a construction company, their blueprints a testament to architectural ambition, embarking on a multi-year project to build a state-of-the-art skyscraper. The initial cost estimates, meticulously prepared based on prevailing market prices, form the foundation of the project's budget, guiding material purchases, labor contracts, and financing decisions. However, As the project progresses, the construction company finds itself grappling with the insidious effects of inflation. The price of steel, a critical component of the skyscraper skeleton, has skyrocketed due to supply chain disruptions and increased demand. Similarly, the cost of concrete, essential for the building's foundation, has surged as energy prices push up production costs. In this scenario, relying on outdated cost data can be detrimental to the project's financial health. If the construction company continues to purchase materials and contract labor based on pre-inflation prices, they risk blowing their budget, eroding their profit margins, or even jeopardizing the project's viability. Job order costing, with its emphasis on tracking actual costs, provides the agility needed to navigate inflationary pressures. By diligently updating their cost records to reflect the rising prices of materials, labor, and other inputs, the construction company can make informed decisions about pricing adjustments, contract renegotiations, and resource allocation. Moreover, by analyzing the impact of inflation on different cost categories, the company can identify areas where cost mitigation strategies might be most effective. Perhaps they explore alternative materials, such as composite lumber, instead of traditional timber framing, or investigate new construction techniques that reduce labor hours without compromising quality. Section 4, the importance of accuracy, integrity, and cost recording. In the realm of accounting, where numbers paint vivid pictures of a company's financial health, accuracy in recording job costs is not merely a desirable trait, it's the cornerstone of integrity, transparency, and informed decision-making. Just as a scientist meticulously documents their experiments to ensure the validity of their findings, businesses must maintain accurate cost records to gain a true understanding of their financial performance. Imagine a software development company, their lines of code transforming innovative ideas into cutting-edge applications. Each project they undertake, whether it's building a mobile app for a startup or developing a custom software solution for a multinational corporation, represents a significant investment of time, expertise, and financial resources. Accurate cost recording is essential for determining the profitability of each project and the overall financial health of the software development company. If time spent on client calls, code debugging, or project management tasks is not accurately tracked and allocated to the appropriate projects, the resulting cost distortions can have far-reaching consequences. Inaccurate cost data can lead to poor pricing decisions, with the company either undercharging for its services and eroding its profit margins, or overcharging and risking the loss of competitive bids. It can also distort profitability analysis, making some projects appear more profitable than they actually are, while others may seem less viable, potentially leading to misguided resource allocation and strategic decisions. Moreover, inaccurate cost recording can undermine the trust between the software development company and its clients. When invoices are based on unreliable cost data, clients may question the transparency of the billing practices, potentially straining relationships and jeopardizing future collaborations. To uphold the integrity of their cost recording processes, Software development companies, like all businesses engaged in job order costing, must establish robust internal controls. These controls, ranging from clearly defined cost allocation methods to regular reviews and reconciliations of cost data, are essential for minimizing errors, preventing fraud, and ensuring the reliability of financial information. Section 5, Technology as an Ally. Streamlining cost tracking. Technology has revolutionized job order costing, replacing cumbersome spreadsheets and manual tracking with real-time insights. ERP systems automate data integration, improving accuracy and efficiency. Digital tools track materials, labor, and overhead, providing actionable insights. Businesses can now make informed decisions, driving profitability and growth. In manufacturing, costs come in various flavors. Direct costs are easily traceable to a product. Indirect costs, or manufacturing overhead, are not. These include electricity, rent, and indirect labor. Accurate overhead accounting is crucial for profitability. In job order costing, allocating manufacturing overhead is challenging. Overhead costs are shared expenses, not tied to specific products. Accountants use a predetermined overhead rate to allocate these costs. It's like dividing a restaurant's utility bill among diners. This rate is based on estimated costs and activity levels. It helps systematically assign overhead costs to jobs. The rise of AI is revolutionizing manufacturing overhead, automating tasks, reducing costs, and enhancing efficiency. AI-powered robots work alongside humans, optimizing production and minimizing downtime. This shift leads to lower labor costs, higher output, and improved quality. AI also optimizes inventory, predicting demand and reducing waste. However, integrating AI requires significant investment and careful planning. Section 4, the allocation dilemma. Choosing the right cost driver. Choosing the right cost driver is crucial for fair and accurate overhead allocation. It should reflect actual resource consumption by different jobs. This requires understanding the manufacturing process and overhead costs. For example, machine hours might be better for high-volume items, while engineering hours suit custom machinery. Regular review ensures cost drivers remain relevant. Section 5, from estimation to reality. Reconciling applied and actual overhead. Reconciling applied and actual overhead is crucial in job order costing. It compares estimated overhead costs with actual costs, revealing overapplied or underapplied overhead. Overapplied overhead occurs when applied costs exceed actual costs, while underapplied overhead is the opposite. This process helps refine cost accounting practices and improve future estimations. Section 1, unveiling the bottom line. Understanding cost of goods sold. In accounting, the cost of goods sold, COGS, reveals the direct costs of producing products or services. It's essential for strategic business decisions, from pricing to profitability. COGS includes direct materials, labor, and manufacturing overhead, excluding indirect costs like marketing or admin salaries. Accurate COGS calculation impacts gross profit and helps optimize costs, guiding businesses towards profitability. Calculating the cost of goods sold, or COGS, might seem daunting, but it can be broken down into logical steps. Start with beginning inventory. Add the cost of goods manufactured or purchased, and subtract ending inventory. This formula reveals the true cost of goods sold. Pricing products or services effectively is a delicate balancing act, a dance between covering costs, remaining competitive, and capturing the perceived value offered to customers. While intuition and market knowledge play a role, a solid understanding of cost accounting, particularly the cost of goods sold, provides a crucial foundation for making informed pricing decisions that drive profitability. One common pricing strategy is cost-plus pricing, where businesses determine their selling price by adding a markup percentage to their COGS. This markup covers operating expenses, such as marketing, administration, and rent, and provides a profit margin. The markup percentage can vary depending on industry norms, competition, and the perceived value of the product or service. While straightforward to implement, cost-plus pricing has its limitations. It assumes that customers are willing to pay a fixed markup above the cost of production, regardless of the perceived value they place on the product or service. In reality, customers often make purchasing decisions based on factors beyond price, such as brand reputation, product features, and customer service. Competitive pricing, as the name suggests, involves setting prices based on the prevailing market prices of similar products or services. This strategy can be effective in highly competitive markets where price sensitivity is high. However, it requires businesses to closely monitor their competitors' pricing strategies and ensure that they can maintain profitability at the prevailing market prices. Value-based pricing, often considered the most customer-centric approach, focuses on setting prices based on the perceived value that customers place on the product or service. This strategy requires a deep understanding of customer needs, preferences, and willingness to pay. It often involves conducting market research, analyzing customer data, and identifying the unique value proposition that sets a product or service apart from the competition. Businesses often employ a combination of pricing strategies, tailoring their approach to specific products, customer segments, and market conditions. Regardless of the chosen strategy, a clear understanding of COGS is essential for setting prices that cover costs, generate profit, and reflect the value delivered to customers. In business, inventory management is crucial for balancing supply and demand. Too little inventory leads to stockouts and missed sales. Too much inventory ties up capital and increases cost. Just-in-time, JIT, minimizes inventory but risks supply chain disruptions. MRP systems use forecasts to optimize orders and timing. Effective management improves cash flow and meets customer needs. Section 5, Embracing Continuous Improvement, Refining Your Cost Management. In business, continuous improvement is essential. It's about efficiency, innovation, and cost management. Small improvements boost profitability and competitive position. Analyze costs, identify drivers, and optimize strategies. Use technology for data insights and track initiatives. Invest in innovation, customer service, and sustainability. Create a culture of efficiency and reinvest savings for long-term success. Let's recap job order costing, a system for tracking costs of specific jobs. It captures direct materials, labor, and overhead, unlike process costing. This method helps businesses price competitively and make informed decisions. In a marketplace increasingly driven by personalization and the desire for unique products and services, job order costing emerges as an indispensable tool for businesses seeking to cater to these evolving customer demands while maintaining a firm grasp on their financial performance. From bespoke furniture makers and high-end fashion designers to software developers crafting custom applications and construction companies building architectural masterpieces, job order costing provides the financial clarity and control needed to thrive in a world where customization reigns supreme. The power of customization lies not only in its ability to satisfy unique customer needs, but also in its potential to command premium prices. When customers seek products or services tailored to their specific requirements, they're often willing to pay a premium for the value of personalization, the artistry of craftsmanship, and the assurance that their individual needs are being met with meticulous care. Job order costing empowers businesses to capture this value, ensuring that they are fairly compensated for the time, expertise, and resources invested in fulfilling these customized orders. However, the pursuit of customization without a solid grasp of cost accounting can be a perilous path. Without accurate cost information, businesses risk underpricing their customized offerings, eroding their profit margins, and potentially jeopardizing their financial stability. Job order costing provides the financial lens through which businesses can assess the profitability of each custom creation, ensuring that they are not sacrificing financial health on the altar of customer satisfaction. By meticulously tracking the cost of direct materials, direct labor, and manufacturing overhead for each job, businesses can confidently calculate their break-even point, determine the optimal markup percentage, and establish pricing strategies that reflect the value they deliver, while ensuring a healthy profit margin. Moreover, job order costing empowers businesses to identify the most profitable types of custom projects, allowing them to focus their efforts on securing work that aligns with their strengths, optimizes their resource allocation, and maximizes their return on investment. The world of business is rarely static. It's a dynamic landscape shaped by ever-changing customer demands, technological advancements, economic fluctuations, and unforeseen challenges. Job order costing, while providing a robust framework for tracking costs and managing profitability, is not a silver bullet that guarantees success in the face of these ever-present uncertainties. Instead, it's a tool that requires businesses to embrace adaptability, continuous improvement, and a willingness to refine their cost management practices as circumstances evolve. One of the key challenges in job order costing lies in accurately estimating manufacturing overhead costs and selecting appropriate cost drivers for allocating these costs to individual jobs. As we've explored, overhead estimations are based on forecasts of future costs and activity levels, which are inherently susceptible to the uncertainties of the business environment. Fluctuations in utility rates, changes in indirect material prices, unexpected equipment repairs. These are just a few examples of factors that can disrupt even the most carefully prepared overhead budgets. Similarly, the choice of cost driver, the activity base used to allocate overhead, can significantly impact the accuracy of cost calculations. As production processes evolve, new technologies are adopted, and product lines expand or contract. Businesses must regularly review and potentially adjust their chosen cost drivers to ensure they accurately reflect the actual consumption of overhead resources by different jobs. Adaptability also extends to responding to external factors that can disrupt production schedules, impact material costs, and create unforeseen challenges. The 2023 Hollywood strikes, which we examined as a real-world example, highlighted the vulnerability of job order costing systems to events beyond a company's control. Supply chain disruptions, natural disasters, economic downturns, these are all factors that can upend even the most well-managed projects, requiring businesses to reassess costs, adjust production schedules, and make difficult decisions about resource allocation. Imagine you're an entrepreneur launching a custom sneaker brand where each pair is a unique work of art. You envision vibrant colors, bold designs, and premium materials, all meticulously crafted. Job order costing helps track costs, price competitively, and make informed decisions. Establish a system for tracking costs, including materials, labor, and overhead. This ensures each sale contributes to profitability. Job order costing is a strategic asset for informed business decisions.